welcome to Iron Financial. This is where we help you forge a stronger portfolio and cut right through all the market weakness. Today, we are putting one of the market's most debated titans, Alibaba, ticker BABA, under the microscope. Actually, scratch that. We're putting it through a full-blown structural stress test. Earnings are right around the corner, and the entire market is basically holding its breath. So the big question is simple. Is this company's foundation solid enough to build on, or is the whole structure about to crumble under pressure? Let's get into it.
You know, you can't even have a conversation about Baba these days without the topic of artificial intelligence just screaming in your face. It is the story. The hype is deafening. You've got analysts and pundits out there shouting from the rooftops that this is, and I quote, the cheapest way to play AI in the entire world. They're trying to reframe the whole company. They want you to stop thinking of it as an online retailer and start seeing it as this deeply undervalued AI powerhouse that's just coiled and ready to spring. You have to understand, this isn't just some background noise. This is the main load-bearing pillar of the entire bull thesis right now. It's the whole story.
Yeah, and that story, that hype, is making the market go completely nuts. I mean, just look at this number. The options market, which is where the real money makes its short-term bets, is pricing in a potential 4 to 7% stock swing on earnings week alone. That is a huge move. So I have to ask the question everyone should be asking, what is that expectation actually built on? Is there any real steel and concrete underneath that number, or is it all just being propped up by the hot air from this AI narrative? You know, a 7% move can make you a fortune, or it can absolutely dig you a hole you can't get out of. We've got to know if we're standing on solid ground before the earthquake hits. That is the perfect question, and that's exactly what we're here to figure out. So here's how we're going to break this down today. Think of it as a 5-stage structural stress test. First, we'll dive right into that AI hype machine and see what it's made of. Then, we are going to build the bull case, piece by piece, brick by brick. After that, you're going to come in and start looking for the cracks in the foundation. From there, we'll tackle the ESG wildcard, and believe me, it's a tricky one. And finally, we will deliver the iron verdict, your actual blueprint for what to look for when those numbers drop.
Okay, let's kick it off. Section 1, the AI hype machine. This is ground zero for the entire Baba story right now. And the fundamental question we have to get to the bottom of is this. Is AI just some shiny new feature they've bolted onto the side of the old e-commerce business? Or is this something truly fundamental, a new pillar that's going to be expected to support the weight of the entire company's future? Let's take a look at what they're actually building.
And when you look at their arsenal, it's actually pretty impressive. This is not some half-baked effort. They are launching a full-scale assault on multiple fronts. You've got Qwen 3.5, which is their big, powerful new AI model. They're talking it up with these agentic-style capabilities, which is really just a fancy way of saying the AI can think for itself, plan, and execute complex jobs without a human holding its hand. That's a huge deal. But then, look at this, RynnBrain. They're moving beyond just software and into what they're calling physical AI. We're talking about building the brains for actual physical robots. That's a whole other universe of potential revenue. And of course, they're not being shy about showing it off. They plan to use the 2026 Winter Olympics as a massive global advertisement for their cloud and AI tech. But perhaps the most important part, we're already hearing whispers and reports that their massive cloud division is seeing a real shot in the arm, all thanks to these AI tools. So yeah, this is a full-scale offensive. They're bringing out the heavy artillery.
Okay. A full-scale offensive. I get it. But you don't fight a war by yourself. They're not operating in some fantasy land where they're the only player on the field. This is a brutal, bloody battlefield. You see it right here on this side. For every Qwen 3.5 they roll out, you've got ByteDance, the TikTok people, rolling out their own model, Doubao 2.0. You've got Tencent right there in the trenches with them, pushing just as hard. And these guys are fighting dirty. They are throwing everything they have at acquiring users. We're talking incentives, freebies, you name it. Anything to grab market share. That puts an incredible amount of pressure on Alibaba's wallet. So sure, having a great arsenal is nice, but it doesn't guarantee you'll win the war, especially when the war is this unbelievably expensive to fight.
That's a completely fair point. The cost of this war is real. And that brings us to the next critical phase of this stress test. Let's move to Section 2 and see how the numbers are supposed to hold up, building the bull case. We've heard the story, we've heard the AI narrative. Now we need to dig in and see if the financial blueprint can actually support the weight of this structure. It's time to move from the hype to the hard data.
Now, the first pillar in any strong bull case is usually Wall Street consensus. And right now, the consensus on Alibaba is just overwhelmingly positive. The average price target from the professional analysts, the people who do this for a living, is sitting just over 195 bucks. Now, depending on where the stock is trading when you see this, that represents some serious potential upside. This isn't just one or two optimistic analysts. This is the collective forecast of dozens of major financial institutions. It's a really powerful signal of professional confidence in where this company is headed. And let's drill down on that consensus, because this chart right here, this is what really tells the story. Of all the analysts covering BABA, you have 18. Let that sink in. 18 with a buy rating slapped on it. And on the other side of that, you've got one hold and one lonely sell. I mean, that is an incredibly lopsided bull-to-bear ratio. This isn't just mild optimism we're talking about. This is overwhelming, table-pounding conviction. When you see a distribution this skewed, it tells you that the professional class believes the company's financial blueprint isn't just sound, it's compelling. For the most part, they are all in. So what exactly are they seeing in that blueprint that gets them so excited? Well, it boils down to two things: growth and expansion. This table lays it out pretty clearly. The projections show a company that isn't just growing, it's accelerating. Revenue growth is projected to literally double from 9% recently all the way up to 18% by 2028. But here's the kicker, the part that really matters. Look at the net profit margin. It's forecast to expand from 8% to 13%. So the key takeaway is they're not just expecting to sell more stuff, they're expecting to be way more profitable on every single dollar they bring in. This is the holy grail for investors. It's the architectural plan for creating massive shareholder value. And this right here, this is the engine that's supposed to power the whole machine, the projected earnings per share, or EPS growth. Just look at that number for 2024, over 1,700%. Now, obviously, that's a wild outlier year, probably coming off a weirdly low base, but it's a staggering projection that's meant to kickstart a whole new era of growth. It normalizes after that, sure, but it's still pointing to solid, healthy double-digit growth by 2026. For investors, EPS growth is the heavy lifter. It's what fundamentally drives the stock price higher over the long haul. And this forecast is calling for nothing short of an explosion.
An explosion on paper? Maybe. But a blueprint is just a pretty drawing. It doesn't mean the building is actually going to stand up. And that brings us to my favorite part, Section 3, cracks in the foundation. I'm taking the floor now because it's time to put this beautiful bull case to the test against the hard, cold, unforgiving reality of what's actually happened in the past. Let's see if this structure can handle the pressure.
Just look at this table. Forget projections for a second. This is history. And frankly, the history is ugly. Quarter after quarter after quarter, you see this pattern of significant earnings misses. A nearly 25% miss here. A jaw-dropping almost 60% miss there. This isn't a one-off bad quarter. This is a clear, documented pattern of underperformance. So when the bulls come to me with a chart projecting 1,700% growth, I have to ask, why on earth should we believe them now when they've been so wrong, so consistently in the past? This data shows a fundamental disconnect between what Wall Street wants to happen and what this company can actually deliver.
And that's the bottom line, isn't it? A beautiful architectural blueprint is completely worthless if the construction crew keeps failing to build to spec. It's one thing to have a bad quarter. Every company does. It's another thing entirely to have what looks like a corporate culture of overpromising and under-delivering. In investing, trust is a critical component of valuation. And when a company repeatedly fails to meet its own forecasts, it just destroys that trust. This isn't just a little crack in the foundation, it's a potential flaw in the very concrete they're pouring.
And it's not just their own internal execution that's a problem. The external environment is absolutely hostile. Like we said before, ByteDance and Tencent are not just sitting around. They are in a knockdown, drag-out street fight for AI users, and they are willing to burn cash to win. This creates immense margin pressure. All those freebies and incentives they're offering could force Alibaba to crank up its own marketing spend just to stay in the game, which directly attacks those rosy margin expansion projections we just saw. And all of this leads to the biggest question mark of all, monetization. The market is getting really nervous, asking how and when all this AI spending will actually show up as real bottom-line revenue. A promise of future profits just doesn't cut it when you're burning through cash today. Those are all valid pressures, no question, which brings us to a more complex but increasingly critical part of this whole structure, Section 4, the ESG wildcard. Now, environmental, social, and governance metrics are fast becoming a key indicator of a company's long-term health and the quality of its management. But with Alibaba, the ESG data is like looking at two different sets of blueprints, and we really need to figure out why.
Okay, so on the one hand, you have a rating agency like Sina Finance giving Alibaba an incredible 4.5 out of 5 stars. That score puts them in the top 10% of all Chinese companies they cover. It paints a picture of a leader in environmental practices, social responsibility, and corporate governance. It's basically a best-in-class rating, a clear signal of quality.
A signal of leadership? Really? Because I'm looking at a completely different blueprint from Sustainalytics, a major ESG rating firm, and it tells a completely different story. It slaps Alibaba with an ESG risk rating of 24.7, which puts it squarely in the medium risk category. And what's even more worrying to me is that this score ranks them 786th out of about 1,100 companies in their industry. That's in the bottom third of their peers. So which is it? Are they a top-tier ESG leader? Or are they a medium risk laggard? You can't build a stable investment on two completely different sets of plans. It's impossible.
Well, I think you have to get granular. You have to dig into the specifics. And governance, the G in ESG, is where the bull case really finds its footing again. This is tangible proof of quality. Just look at the board composition. Alibaba has 64% independent board members. That's well above the industry average of 58%. And that's not just a trivial number. It's a crucial metric that suggests stronger oversight, better accountability, and decisions made in the best interest of all shareholders, not just a few insiders. You can't have a durable company without strong governance at its core. It's the bedrock. And that strong governance translates directly into what you see right here, a fortress of a balance sheet. I mean, the data is undeniable. Net debt to equity is a tiny 0.2. The quick ratio, which is a key measure of whether a company can pay its immediate bills, is a very healthy 1.81. And maybe most importantly, look at the Altman Z-score. That's a formula designed to predict if a company will go bankrupt. It's at 3.3. For context, any score over 3.0 is considered very safe. So while you can sit and debate these qualitative ESG ratings all day, the quantitative result of their governance is a balance sheet that is made of solid iron.
Okay, but that raises the most important question of all, doesn't it? Does a medium risk rating from a major agency even matter if the balance sheet looks this strong today? Here's my concern. A poor ESG risk rating, especially one that ranks you so low among your peers, might not be a reflection of the past. It could be a leading indicator of the future. It could be a warning flare, flagging potential problems, regulatory, social, or environmental, that aren't visible in the financials yet, but could cause severe structural damage down the line. A fortress is great, but not if it's built on a seismic fault line you can't see.
And that tension, that exact conflict between today's strength and tomorrow's risk, is what every investor needs to be grappling with right now. And this brings us to our final section, the iron verdict. It's time to synthesize all these conflicting arguments and give you a clear, actionable blueprint for how to analyze this earnings report for yourself.
So here it is, the final stress test, laid out side by side. The bull case is built on four massive pillars: that dominant multi-front push into AI, an incredibly strong Wall Street analyst consensus, those robust, forward-looking growth projections, and the fortress balance sheet we just covered. It's a powerful, compelling structure on paper.
But the bear case sees some very significant cracks in that structure. You've got the documented history of missing earnings, you've got the intense and incredibly costly competition in the AI space, you've got those contradictory ESG signals that raise serious questions about long-term risk, and looming over it all is the persistent uncertainty about how they're actually going to make real money from all these new AI toys. Each one of those is a potential point of catastrophic failure.
So, when that earnings report drops, here are the 3 critical data points you need to zoom in on. This is your blueprint. Number 1, look at the relationship between AI spending and the profitability of their cloud division. Are all these heavy investments translating into actual bottom-line results, or is it just a giant cash furnace?
Exactly. And number 2, zero in on the margins in their core e-commerce business. Is all that competition forcing them to spend more and cut prices, which eats away at profitability? This number will tell you if those external threats are really landing blows.
And finally, number 3, and this is maybe the most important of all, listen very carefully to the forward-looking guidance. This is everything. Does management's own forecast validate the massive hype from Wall Street, or do they sound cautious? Do they acknowledge the risks we've laid out today? Their words, their tone, will set the direction for the entire market.
Which leaves us with the final, ultimate question for you to decide. After running it through the stress test, do you see Alibaba as a foundational pillar for your portfolio built on the solid rock of AI growth and financial strength? Or do you see a massive, impressive structure that's riddled with cracks, standing on the brink of buckling under the pressure of its own lofty promises? The earnings report will give us the next critical piece of data, and now you have the blueprint to analyze it like a pro. For us here at Iron Financial, the entire thesis hinges on that forward guidance. If management comes out swinging, confidently reaffirming the AI growth story with hard numbers to back it up, then the bull case holds strong. But if they waver, if they start talking about margin compression and pull back on the outlook, then all this AI hype is just hot air, and this entire structure could have a dangerously weak foundation. We will be watching. Thanks for joining us.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.